In this video, I'm going to talk about accumulation and distribution, which are a key component of market structure. Of course, knowing this is not essential, but having some awareness of it does help. Over the years, I've noticed that struggling traders often use very subjective methods of trading, like support, resistance, and drawing trend lines. Another example of such method is using the Wyckoff accumulation schematic, as shown on this diagram. And of course, whilst this is useful to be aware of, in trading, it's not about what you know, it's about how you use what you know. And more information does not equal more profitability in trading, and actually simplicity is better. Trading does not need to be hard, but people find ways to overcomplicate it. But nonetheless, we will speak about this. The idea is that markets have certain phases. We have a downtrend, we have consolidations, and all this Wyckoff accumulation schematic is showing is a more detailed outlook of these concepts. Of course, textbook is very different to real life, and it's actually difficult to identify such detail on this diagram on actual charts. And again, it's so subjective as well. It's easy to look at charts, and then in hindsight, once price action has played out, to then compare it to the Wyckoff accumulation schematic. But if you're going to trade purely based on this, you can take a lot of losses, just due to the subjective nature of it. And personally, I don't know a single successful trader that trades purely based on this, because it's difficult to map out each phase of the accumulation schematic to real-life charts in real time. And whilst we won't be using the Wyckoff schematic for our trading, there are aspects of it that are still timeless, because it is an old market theory based on psychology. So here we can see on this diagram, there's a downtrend, the markdown to the far left. Then we have this accumulation phase. And then we have this uptrend, then distribution. Then we have a downtrend, back to accumulation, then another uptrend, and then distribution. So in general, these are the phases of market cycles. But of course, real life is very different to textbook. And as we go over chart examples, this will be more evident. Trading is like driving a car. With enough chart exposure, you will develop a road sense, and identifying these on charts will be second nature. But let's look at the accumulation and distribution phase in more detail. So this is a simple accumulation schematic. And as you can see, there's a sideways range, consolidation. Then there's a final push down, taking out the stops of the lows of the range. And this is a liquidity hunt. And then we have this quick spring up and then a reversal. And so during the breakout of this consolidation phase, many traders might have been FOMOing or having limit short orders. So market goes down to clear those sell stops. Then the market goes in the opposite direction and then continues further up. And one of the main principles of markets is that markets are designed to cause as much pain to the majority as possible. And mass market psychology often teaches things like triple bottoms or triple tops. But often in real life, there might be a triple bottom, but there's a final liquidity grab where the stops for people opening long positions are taken out, and then the market reverses in the actual intended direction. But again, as you look at more chart examples, this will become more clear. So after this accumulation phase, and once the stop losses have been triggered, we then have the uptrend or markup, and that can lead to a distribution phase. During this distribution phase, we have a sideways consolidation. Then we have this liquidity sweep in which the highs are taken out and stop losses are triggered. And at this point, some retail traders might be FOMOing and opening long positions. Other traders might be taking profit. Then price goes back into the range and then dumps, leading to the next phase of markets. So looking at this chart to demonstrate distribution, on the top left, there are three highs, as indicated by the white line. The third high is slightly higher than the previous highs. And the third high has actually taken out the stops, so grab the liquidity, and then we've had that massive sell-off. And so this is an example of transitioning from the distribution, then the markdown, and the back to accumulation to the far right again. And this just demonstrates markets don't go up and down in a straight line. Markets often have a sell-off, then a sideways price action, so accumulation. Then we have a markup, that can lead to a sideways consolidation again, which is distribution, and then so on and so forth. But of course, don't try to randomly buy or sell into accumulation or distribution, because it's quite subjective. But I'm just highlighting these to make you aware of it. Overall, we don't need a deep understanding of accumulation and distribution, but I've just included it for completion's sake. But as we cover the strategies later on in the training program, you will see how we can bring it all together. One concept we will cover is supply. Looking at this chart example, as you can see, there's a clear downtrend. The price retraced into the supply, but you could perhaps combine your knowledge of distribution, which is the consolidation on this diagram, into the supply as a further confluence to improve the chances of winning the trade. And that could mark the start of this downtrend as indicated by the down arrow. And if you have a valid supply combined with this distribution phase, that could perhaps act as a nice selling point. But overall, an understanding of distribution and accumulation is not essential, and you will see how it all ties together with more chart examples. That's all for now, and see you in the next video.